So right here, we're looking at Euro JPY. So for those of you who are completely green to Forex, basically what we have here is the currency for Europe, which is the euro, and the currency for Japan, which is the Japanese yen. And what we do is they basically pair the two together, and you can invest. You got the price over here, which is currently trading at $132.12, and you got the time down here. So I'm on a 5-minute chart. So each candle is 5 minutes worth of price action. And basically what you want to do is, if you feel as if price is going to go down, you want to be able to sell it. And if you think price is going to go up, you want to buy in. So this is what it would look like. You got the buy and sell button. You can do a market execution, which is basically as soon as you hit this buy or sell button, it will automatically execute the trade and enter you in. Or you can place a limit order. And what a limit order is basically I set a sell limit order for this trade right here. So you come over here, you hit sell limit, and you're going to just say you risk 2% of your account. You want to sell Euro JPY at 132.75. So $132.75. You fix your stop loss. And what your stop loss is going to be is basically if the trade goes against you. All right, so let me hit the replay button. So this is about what price looked like when I sent it out. All right, so what this tool right here is basically my entry price, which is right here. This is my stop loss. And the stop loss is basically, once the trade gets up here, it's going to activate your sell limit and put you into the trade. And what you're anticipating is for a price to activate your sell limit and then put you in profit as it continues to drop. But your stop loss will protect you from losing money. So basically, when price gets up here and activates your trade and starts to go against you and hits your stop loss, it's going to take you out of the trade with minimum loss. All right, so we got a sell limit, we got our stop loss, and our take profit right here is basically where we want to get out of the trade at. So once price comes up here and activates our sell and puts us in profit, we're going to set a specific price for our take profit. That way, when price gets down here, it's going to automatically close the trade and you take home your money. All right, so I'm basically going to replay this. First, I want to come over here to show you. All right, right here, we entered the trade right here and took profit down here. Okay, so up here is where is what you're seeing right now. It's just on a different time frame. So this is the 1 hour time frame, which is what you're seeing right here. You see, I got the same thing you're seeing right here is what I sent out to the group. And I basically told them, this is my POI, my point of interest. And once price gets back up in that level, I'm going to be selling. All right, so go down to a 5-minute time frame, which is where I found my point of interest at. And I'm going to replay this for you. All right, so at this point, it's probably 10 or 11 o'clock at night. I set my sell limit. And you can carry on about your day. You know, like this is the time that I usually go to sleep. So I set my sell limit and boom, price is doing this thing. All right, so at this point right here, we are actually in the trade. Price came up here and triggered our sell limit, and we are in the trade now. So at this point, we're in profit. So this is our entry price right here at 132.75. All right, so this is our entry price. So as soon as price drops down, we're selling it, so we're in profit. Now, as long as it's up here in this red area, we're negative. So money's coming out of our account. It's floating profit and loss. So once it drops down below our entry price, we're in profit. So you're probably thinking like, why do I have this area marked up right here? So this candle right here is what we call a order block. And I'm not gonna really get into it too much, but this candle is basically what I base my entry off of. The low of this candle right here. So my prediction was as soon as price comes up and hit this area right here, it's gonna reject and price is gonna drop. As you can see right here, this is just on a 1 hour time frame. This is the 1 hour order block, and this is the 5 minute order block. Basically an order block that's inside of another order block on a different time frame. So that's what I base my entry off of. So I sent that out to everybody that's in my Discord channel so they can make money. Let's speed this up a little bit. So basically, like, price did exactly what I predicted. Okay, it came back up and tested our entry one more time. And then price melted. It hit our take profit right there. So this was the sales signal that I sent out yesterday. I got several more pairs that, you know, we traded that ended up doing the exact same thing. So this pair right here is the Great Britain pound, the British pound versus this Japanese yen. And this pair right here is directly correlated with Euro JPY. So both of them are paired with the Japanese yen. This is just the European currency, and this is the Great Britain currency. So they basically correlate with each other. So this right here is a buy signal. I basically told them once price gets down into this level right here, that I'm going to be looking to buy to sell. So we're going to place a buy position down here. And once price gets back up in this area, we're going to close the buy and then enter a sell. So I'll replay this for you right here. Drop down to a lower time frame. All right, so at this point, we entered the buy, and price immediately went into profit. Money in the bank. All right, so once price did this, I entered another buy position. So you're probably wondering, like, how the hell do you do this? Like, it's all about time and price for one, and overbought and oversold conditions. So I get on the daily time frame real quick, and each candle is 1 day, 24 hours worth of price action. So price has been going up for quite some time, and it's extremely overbought at this point. So price needs to, all right, so basically what happens is once price goes up for so long, it starts creating imbalance and inefficient price action. Price jams up real quick for like almost a month straight. So this leads me to believe that price is overbought and it needs to reprice and rebalance all of this price action. All right, now here we are on a 1 hour chart, and you see the green and red boxes right here. This delineates the time. So from the green to the red, this is basically 24 hours worth of price action. So right here where the green meets the red, that's at 8 o'clock in the morning, which is basically New York session. And it's one of the most volatile times inside the marketplace. All right, so my initial analysis is to sell GBP JPY because it broke structure to the downside, and I feel like price is going to drop because it's been going up for so long. So it basically, once it was down here, I wanted to buy it back up until it got into a premium price. You want to sell at a premium and buy at a discount. So down here was at a discounted price, so I wanted to buy it. Think of it like this: like if you're going to buy a vehicle, you want to buy it at the cheapest price possible, right? So this will be our current dealing range in this scenario. So $156.80 to $157.29. So you don't want to buy up here in this current dealing range because prices, you know, it's too high. So once it drops back down, once it reaches this level, you're at a 62% discount. So price is basically 62% off. So you could buy it right here as price is coming down. And this tool right here that I'm using is called a Fibonacci tool. and it basically measures the price swing right here. So the deeper it comes down, the more discount you're getting. So boom, price came up here and closed the buy position in profit, and I entered a sell position right here. So keep in mind, around the same time, Euro JPY was doing the same thing right here. Around the same time, Euro JPY and Great Britain pound versus the Japanese yen. They're directly correlated, so they're going to basically move in the same direction. So right here on Great Britain pound versus Japanese yen, I have this 5-minute order block here. Looks the exact same of this 5-minute order block right here. So I decided to sell GBP JPY and Euro JPY at the same time. And this is what the trade looked like. This is my 5-minute point of interest. And it's also, all right, you want to find your current dealing range. So this is the high up here at $158.21. And this is the low at $156.80. So you want to get your Fibonacci tool and measure your price swing, right? All right, so the levels right here that I have marked up in blue, this is what I call a sweet spot. And it's basically an area that price tends to react at a lot because it's considered to be in a premium area where people want to sell at. You want to sell as price is going up, and you want to buy as price is going down. Premium discount. So let me do this. All right, so this right here is basically just measuring this price swing and splitting it in half right here, 50%. So anywhere from this area up would be considered a premium price. All right, so anywhere from 50% down here, that would be considered discounted price. And this is your dealing range from here to here. All right, so this is why when price came down and crossed the threshold from premium to discount, I decided to buy down right here and right here. And once price crossed this threshold of the 50% up into the premium area, I found me an order block inside the 5-minute time frame, which is right here, and put my stop loss right above this high and decided to go for it. All right, so right here, let me drop that down to a 5-minute time frame. All right, so you see this order block right here. Price came up and dug into about the 50% area of this order block. Let me measure it. So this is areas that I look for when entering off of an order block. Let me measure the bodies of it. Just basically the majority of the volume inside this candle. All right, so that's 50% of that order block right there. And you can see price came up and tapped it right there at $157.66. So price tapped up into that order block and immediately started to decrease in value. And I sold it, therefore I'm gaining profit. You're probably thinking, how can you sell something that you don't own? Good question. Like, I didn't understand it at first either. But it's a very lucrative business. It's a multi-trillion-dollar business. Every day there's trillions of dollars coming in and out of this market. All you got to do is create an account with a broker, determine what leverage you want to use, 1 to 500, 1 to 100, things like that. So basically, one of the main things that I look for when trading is, like, I want to do the exact opposite of what the masses are doing. There's so many people from all over the world who are buying and selling each currency pair, right? And you have retail traders, which is probably 90% of the participants in the marketplace, which are clueless individuals who think that, you know, it's a lot to get into, and I don't really feel like doing that right now. But you have retail traders and you have smart money traders. I consider myself to be a smart money trader because I trade smart money concepts and not retail logic. So basically, I target imbalances, and what imbalances are, you know, inefficient price action. where you have just strong down moves, nothing but black candles with no green candles in the area. Notice how price comes right back up here and targets this area. So basically that I use that to my advantage. And I also use relative equal lows and equal highs. Basically like this area up here would be considered buy side liquidity because it's relative equal highs. And you got a lot of people who sell from this area. And when they sell from this area, they place their stop loss up above. They place their stop loss up above this area, which generates liquidity. And what is liquidity? It's money. And you want to target those areas, just like down here. All right. So basically what I'm doing is just switching time frames to get a feel of the market structure. So price has been going up and up for so long. And this area down here would be considered an area of support for the 90% of people who participate in this market. Therefore, they think that every time price comes in this area, it's going to bounce up and go up because it reacted from this price area so many times. And what that is causing is a lot of buyers to come into the market every time price jumps down into this area. So they're placing their stop losses down here, which is leaving money on the table. Everything in this red area, this is traders from all over the world, is their money, right? Because they're buying from this area of support. They feel like this area will support price and cause it to go back up. I'm targeting their stop loss, right? They think as soon as price gets back down in this level, it's going to bounce and go back up. But I'm pretty much an expert at reading price action. And at this point, I know price is going to drop to take out all these retail traders who think that price is going to go up. So every time I enter a sell, there's another trader. The broker is matching my trade with theirs. So every time a trader wins, there's somebody on the opposite end of that trade that's losing money. You get what I'm saying? So I'm selling from here, and my take profit is basically where these guys' stop loss is at. They're predicting price is going to go up, and I'm predicting price is going to go down. All right, so at this point, price hits that level and jams straight through it. Now, this is what I mean. This is the difference between smart money traders like myself and 90% of the participants in the marketplace who claim that retail logic is basically gospel. Like they believe in it like a religion, and I discredit and disprove this theory every time I trade. And this is a perfect example of it, right? They think that this area is going to cause price to go up, and you always want to do the opposite of what the masses are doing. You know, like 90%, they say that 90% of market participants lose money, right? Be the 10%. Be the 10%. And this is the value that PZFX trading brings to the marketplace. And my theory is this: if there's 90% of people in the market that's losing money, that means that there's 90% of people that are winning money. You see what I'm saying? That's just how I look at it. Because like there's millions and millions of people who participate in this marketplace. What you see me doing right here is something that I love to do. It's basically called swinging price. Like I like, this is my definition of swing trading. You know, people will argue with me about that, but you know, I call it swing trading because I bought down here, I swing price up here and sold it down. This is being in sync with the marketplace. All right, so here's another example right here. This is the Great Britain pound versus the Australian dollar, GBP odd. So right here, I sent this chart markup out to the team, and I basically told them, like, hey, this area right here is my point of interest. I entered a sale right here. I was anticipating price to come up here into this level, but I told them that I went ahead and entered a position here to secure, you know, secure my position. So right here, I said, I placed a position on GA. I'm leaving my pending sell limit as well. Here's another example of it. And you see this area right here was an area that I was planning on exiting my sell position. So I want price to come up here into this level and come down here to where you see this imbalance. This is called a BISI. It's buy side imbalance, sell side inefficiency. It's just one major candle, one major push up, creating a inefficiency in price action, right? That's basically where price jams up so fast from $1.83 all the way up to $1.84. A 1 penny move, they jam price up, and it basically created an imbalance in the marketplace. And then price action all needs to be balanced. That's why it fluctuates up and down. You see the green candles, which symbolizes price gaining value, and you see the black candles, which symbolizes price decreasing in value. The marketplace likes to stay balanced. All right, so I sent this out. All right, let me hit the replay button. So price was around this area right here, and sell side liquidity. This is, once again, this is money. Sell side liquidity. Liquidity is money. And basically what this area is 90% of people out there who are participating in this marketplace would call this a area of support. This is what retail traders think is support, right? So they think that every time price hits this area, they're gonna buy because it bounces off this area and goes up. That's nonsense. It's subjective, and there's no true meaning behind support and resistance in trend lines. Okay, like they're probably saying every time price comes down and hits this trend line, it's gonna bounce and they're gonna buy it. Smart money traders on the opposite end looking to sell because they know that retail traders are gonna be trying to buy down here. So here I have an order block which ended up not hitting. All right, so let's look right here to see exactly where I entered from. All right, right here, 1.84920. All right, so I had a sell limit resting right here, and I market executed a trade once it got up into this area. So watch this. All right, so right here. All right, so right here I entered sell position. Like I said right here, I placed a position on GA, but I'm leaving my pending sell limit right there. And this is the area of the marketplace that I'm targeting because, like I said, a lot of these rookie traders, they're going to think that this is a support zone, and every time price hits this area, it's going to go up, and you want to target those clowns, right? Boom. So price comes down here. Let me speed this up. All right, so boom, here we are. Price takes out the liquidity that is resting here in this area. It's basically a consolidation or accumulation, whatever you want to call it. There is money being generated on both sides of this area right here. So that is an area to target. Boom, price came down here. This, like I said, this was an area that I was targeting in order to exit the trade. Like I said, right here. Boom. So price came down there, hit that imbalance, and it was a beautiful area to exit that sell position. You see what I'm saying? If I would have tried to hold it until, you know, price kept dropping and dropping forever, then I would have lost more than half of my profits, right? This is why it's vital, it's essential to learn these areas where you exit your trade at. And that's something that I'm very good at, and it's another aspect that I can help people really master. This trade right here fell short. Didn't really give me anything. This is US Wall Street. It's basically the top 30 stocks in the United States. And it's one of the most volatile assets that you can invest in. Price moves up and down very fast, and it's valued at $35,613 right now at this point. So it's a very expensive asset, and you really have to be careful trading this pair because you can gain a lot of money real fast or you can lose a lot of money real fast. Like this is a 30-second chart, and you can just look at the volatility. Like price just moves up and down so fast. You know, within a 30-second time frame, it bounces up $5–10 in value. This is a pair that I'm very good at trading. I mean, you could just look at it, like price has been going up and up for years. Okay, for years it's just been going up nonstop. This is a weekly chart right here. Each candle represents 1 week, right? So it's very easy to determine to buy at a discounted area. Like you find a price swing. Like I participated in this trade right here, right? So once again, we have our price swing, this low and this high. So you want to be patient and wait on price to come down until it's 62% discounted. So this is like I said, my sweet spot. And it's also this kill zone. All right, let me do this. This is what people in the trading community call the kill zone or sweet spot, right? Boom. And it is 62% to 70.5% discounted. And it's also coupled with a order block, which is this last down candle this black candle right there, right? So when you have your kill zone that is also coupled with a order block, that's a very high probability setup. So once price came down into the top of this order block right here, in this area where I have these red lines, this is where we participated in a buy position. I have a group down here. It's called indices. And as you can see, like here's a trade on SPX 500. This is basically the top 500 companies in the US. This is the before picture that I sent out, right? Price came down, it's in a discounted area. We bought right here with 0 drawdown. That means we entered the trade and did not suffer any negative drawdown, right? We entered the trade right there, and this is the results of that trade right here. And so basically we bought in at $4,332 and we took profit at $4,500, right? So let me hit the replay button. So before price even gets down here, you should automatically be able to identify your point of interest. You have your order block right here, and it also couples with your kill zone. And another reason why you should buy at this area, okay, for one, it's a discounted price. It's highly discounted. You want to buy down there, and you have perfect target up here, which is equal highs. You want to always take profit at equal highs. This is buy side liquidity. And why? What's up here? Retail traders' money. They're selling from this area, right? Every time, this is what they call an area of resistance. You know, the support and resistance theory that retail traders swear by, all right? This is their resistance area. Every time price comes up here, it bounces off this area, so they're selling, right? So they're selling here. They're selling here. They're selling here. And they're placing their stop losses right up above here, which is generating liquidity. But smart money traders know that this asset is extremely bullish, meaning price has just been going up and up and up. Look right here. Here's another perfect history repeats itself, right? They play. Okay, the market will give you signatures, right? It happens all the time. Like right here, price trades up and comes down, and you have an order block right here. Price digs right down to that order block, and boom, goes up. Okay, same thing happening here. You have a little order block right there. Price trades up, comes back down into that before going up again. So same thing happening here. This would be like a weekly order block right here. So what retail traders are thinking is that once price gets back up here, they're going to sell. And don't get me wrong, it might work for them, but it's not going to work a lot because this is going to happen, what I'm about to show you. So we bought in down here, place your stop loss in a comfortable area, and you want to target where retail traders place their stop loss up here in this area. All right, so watch this. Right? You see what happened? So price came down into a discounted area, hit the order block, and we targeted retail trader stop loss. Boom. So we cashed out and they lost money here. Because once again, they think every time price comes up into this area of resistance, it's going to drop. But it didn't. It came up here into this area, showed a little resistance, and then boom, took them out. All right, so here recently, I sent this trade out to PZFX Signals. I basically run a signals group to where, there ain't no chat room, there's no nothing. It's just basically me sending out trade ideas to people so they can make money. And we had 2 trades on US 30. This was the first one. This was the second one. I'm not going to go over these right now. I'm about to wrap this up, actually. I really hope you guys found this insightful. Like, if you have any questions, reach out to me. If you want to join my Discord channel, hit me up. I'll send you the link. I hope you guys have a blessed weekend.